Happy Monday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Monday, December 30th, 2024. As always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. So today's key macro question is, will 2025 resemble 2024? Our answers are, that is a loaded question, given that we know there will be a lot of change from a global macro thematic perspective. Some of the change will be good for asset markets, specifically tax cuts, much more M&A, Doge, et cetera. And some of the change will be bad for asset markets, specifically tariffs, a too strong US dollar, and stagflation potentially lowering the strike price of the Fed put. Probably the most concerning dynamic with respect to all the change is the fact that our global liquidity cycle analysis confirms 2025 features one of the most significant global refinancing needs ever across both private and public sector debt. How much balance sheet capacity will global investors have to roll this debt, and how much will they even want to roll it in the context of the laundry list of changes we've just detailed? Be careful not to extrapolate 2024 or even post-election performance well into your expectations of future asset prices until you develop a high probability scenario for the size, the sequence, and the scope of the aforementioned global macro thematic changes. Our fundamental research can certainly help you do that, and our KISS and Dr. Mo signals can help you risk manage your portfolio profitably amid the heightened uncertainty. And boy, is there a tremendous amount of uncertainty as it relates to pending fiscal, monetary, and regulatory policy changes. Transitioning to our 42 macro dashboard here, as always, we'll wrap up with a question from our community. This one's regarding specifics to kitchen sink the economy. It says, Darius has said a few times that if he were Donald Trump, he would kitchen sink the economy. What are the main specific things you would want to do this, please? Or does he just mean drastically cut spending and reduce the deficit? So there are obviously several things you can do to kitchen sink the economy as an incoming administration. Number one, most importantly, which requires obviously Congress, is to dramatically cut spending and cause a slowdown in the economy from that perspective. Obviously, Doge is here to achieve some deficit reduction. We have our doubts on whether or not it will achieve quote unquote significant deficit reduction, specifically by Doge. What we were considering a significant deficit reduction is at least a 300 basis point decline in the deficit to GDP ratio. So we're currently at 7.1%. We need to get that down to 4, in my opinion, to quote unquote achieve significant deficit reduction. And Doge's remit, in our opinion, does not allow for them to do that. But that's a separate conversation. That's a very loaded conversation. But one of the other things that President Trump and his administration could do, obviously, twofold. One, you can go bananas with tariffs, right? The tariffs are obviously going to be a negative catalyst for both the economy and asset markets, specifically through the lens of a too strong U.S. dollar. We've written about that and presented information about that ad nauseum over the past several weeks in our published research behind our paywall. And then secondarily, you could also have a significant change in net financing policy from new incoming Treasury Secretary Scott Bessent. Recall that he's been hypercritical of Janet Yellen's sort of decision to flood the market with bills, which has reduced pressure on overall financial assets by draining the reverse repo facility and other elements in terms of, and also starving the market of coupon and duration supply, which ultimately forces investors further out on the risk spectrum. So if Scott Bessent changes that, that will remove a positive tailwind for the asset markets. Obviously, tariffs would be an incrementally negative tailwind for asset markets. And you're talking about Doge, which I think will generally be celebrated by asset markets. But if it's too big or too draconian with respect to the austerity, then you could actually have a significant slowdown in the economy. So those are just some of the things that we think could potentially cause, could potentially help President Trump kitchen sink the economy. Like I said, I think the smartest thing he could do as an incoming president, second-term president, is destroy the economy and asset markets very early in his administration, blame Biden because he's got to fix all the things that he's trying to fix because of Biden, right? Tighter border policy, which would slow down the labor market from a labor supply perspective, tariffs, all this stuff. You can just blame the outgoing administration, do all the bad stuff first, and then from that point in the slowdown in the economy, from that point, in the most likely crash in asset markets, you can have a straight, uninterrupted, multi-year recovery in both the economy and asset markets, similar to what Ronald Reagan did early in his first 2 terms. So I think there's a blueprint for this, and I think if they're smart, they will implement the blueprint. But I'm not so sure that President Trump is going to be comfortable with not, sort of achieving some of the campaign promises for the working class folks that he bandied about on the campaign trail early in his administration. So there's going to be a push-pull between President Trump's desire to remain very popular versus what is actually the smart strategy if you're going to manage the economy from this perspective. So we'll wrap it up there. I hope that was a good discussion. If you've missed our Doge, what will it take to prevent Doge from failing video with Luke Groman. I highly recommend you check out that. We did a deep dive on Doge this past weekend in our most recent Around the Horn presentation here. That's, I would say if on a scale of 1 to 10, if my conversation with Luke Groman was a 5, then what we produced in Around the Horn this weekend was a 10. So I would highly recommend you guys review that if you have not reviewed that. And then the global liquidity cycle analysis that's featured in our left tail section of our December 2024 macro scouting report, as well as our outlook for inflation, tariffs, labor supply, slowing labor supply, and all those things, and how they're likely to impact the economy from a stagflationary perspective. So definitely make time to review those materials, and obviously we'll catch you back here. When will I see you next? On Thursday, January 2nd. So we're going to be offline, our firm, tomorrow and Wednesday, wrapping up the year, bringing in the new year. And we just want to say we thank you, appreciate you guys for being on this journey with us. Hopefully we helped you make and save some money this year. To the extent we did that and you're not a client, we highly recommend you check us out. And if you don't check us out, we appreciate you anyway, because it helps us. Your engagement helps us grow the business and get our message out there. Because our message has been consistent since the day we started this firm, which is I don't think we have to dumb down the best of institutional macro risk management research. In fact, I think we're proving daily with the testimonials we receive from thousands of our clients that we are smartening our entire community up, especially our client base, and making them better investors, and they have better performance in their portfolios as a result of that big bet that we made at the beginning of our company almost 4 years ago, which was, I don't think we need to be dumbing things down. I think we need to be smartening people up, and I'm really proud of our community because it shows that we are doing just that. So wrap it up there. Everyone have a wonderful, happy holiday, New Year, happy New Year. We'll catch you back here in 2025. Cheers.